Hi, this is David Dickens, and today we are going to unpack a little bit of the one big, beautiful tax bill that just got passed last week. So it's a very long bill, but I've identified three things that I hope are of particular interest to you. So I'll go get Walter and we'll get started.
Back again on Cover Your Assets, KC. Walter Storholt here alongside David Dickens, President and Wealth Advisor of Creative One Advisors Group, based in Overland Park, Kansas, but serving you throughout the Kansas City area and beyond. Find us online at creativeoneadvisorsgroup.com. Well, David, we've got a good topic today, as you teased it, that big, beautiful bill, or we can simplify that maybe to just the new tax law, right?
Yes. The much anticipated, much awaited tax law.
Yes, 800 pages worth. And
Can
so
you
you're going to help
believe
us boil that down a little bit, right?
I mean, yeah, that's all Washington. So I've heard estimates of 800, 850, over 1,000. It kind of depends on, I guess, how you wanted to draw your headline, but
yeah,
it's a lot of words.
Or what font you were reading it in, maybe, right? Like, remember back in the old, maybe back in the school days, you'd make that a 12.5 font to get that 2 pages report to submit, that kind of thing.
Yes, or include you had to do 1,000 words, and so you included what was in your footnotes too.
That's right, exactly. Yes, all the tricks, that's for sure. Well, you're going to break this down into 3 easy things for us to understand. Certainly not a comprehensive list of everything in the bill, but maybe these are the 3 things that, would you say, might impact the majority of our listeners the most?
Yeah, I thought through my client base and who I know are listeners to this podcast, and thought, okay, you can't cover everything. What are 3 things that might, not just for retirees, not just for people working, but kind of try to cover the 3 things that I thought would be most important, most relevant to our listener base. So that's what we got.
All right, let's dive in. And I see the first one on the list here, David, and I'm chuckling because I had a family member just yesterday say this exact thing to me, this bit of a misunderstanding that I think has kind of bubbled up from the bill.
Yeah, so the misunderstanding is no tax on Social Security income. And I understand, I didn't see it, I guess because I don't claim Social Security yet, but evidently the Social Security Administration sent out some sort of post on maybe social media or something that said they perpetuated this myth that Social Security is no longer taxable. Well, it is. But what they did, and I'll tell you why they did it this way in just a minute, but they did a pretty good job of doing what they could do under a reconciliation bill to actually pump through some words that will eliminate taxes on Social Security for a lot of taxpayers. So first thing they did was they made permanent the big increase to the standard deduction that came through in the 2017 Trump tax bill. I guess I ought to preface this by saying the reason why this was so important was the 2017 tax bill, which cut everybody's tax rates. Those rate cuts were permanent for corporations, but they were temporary for individuals. They were going to expire on December 31st of this year. And so the reason that there was this big rush to get this through was so that tax rates on individuals didn't revert to the higher levels that they were before 2017, and that the standard deduction didn't go way back to where it was. So that tax bill made it such that the vast majority of Americans do not itemize on their taxes anymore. They just get a big, juicy standard deduction, and that totally simplified preparing people's taxes. So one thing that this bill did was make that larger standard deduction permanent. But as it relates to taxes on Social Security income, what they did was they added a nice big chunk of additional standard deduction on top of what you were already getting. And the goal there was to eliminate Social Security taxes on most people. So here's a little bit of numbers. I'm going to try to keep it pretty high level. But for instance, if you are married filing jointly, the new standard deduction, the base standard deduction this year is $31,500. If you are over 65, you get another $1,600 if you're married filing jointly. If both of you are over 65 years old, then you both get $3,200. So that takes us up to $34,700. And what this tax law did was it added another $6,000 per person if you're over 65 years old. So, married filing joint, this year, and through 2028. So this little provision is only good for 4 years, 2025, 26, 27, and 28. But your standard deduction, married filing jointly over 65 years old, is now, if you're both you and your spouse are over 65, is now 46,700. If only one spouse is over 65, then it's 39,100. So effectively, that eliminated, I think I saw a stat, and don't quote me on this, but I'm going to say it out loud. I saw a blurb in somebody's website that said that eliminated Social Security tax on over 90% of Americans. So that was pretty good. So it's an additional $6,000 per person if you're over 65. It expires in 2028. The problem with it is it phases out if you are considered to be a high earner. So if you file single, your standard deduction is now $23,750. However, if you're single and you make more than $75,000 of adjusted gross income, or married filing joint and your adjusted gross income is over $150,000, they start to reduce that $6,000 bonus. And it gets totally phased out if you're filing single, and your adjusted gross income is $175,000. If you're married filing joint, that bonus deduction gets eliminated over $250,000 of adjusted gross income. So they were able to say, frankly, for low-income Americans, they probably don't pay any income tax at all. So it really didn't help them. What this really helped was middle-income Americans, retired middle-income Americans that make single between under $75,000 and married filing joint under $150,000. So it's pretty good. It just eliminates it if you make what the government thinks is too much money in retirement. And then one little bonus piece of information: why didn't they just deal with taxes on Social Security directly? Why did they take this roundabout way to get there? And the reason is it's something called the Byrd Rule, B-Y-R-D. It's Robert Byrd. He's now deceased, but he was a longtime senator from West Virginia. And back, I think, in a 1974 tax fight that was going on, what they put in place, usually to get something through the Senate, you have to have 60 votes out of the 100 people that are sitting there. But if you do something under something called budget reconciliation, you only need 50 votes. But you can only do certain things and have it fit under budget reconciliation. And some of the things you can't do are monkey with Social Security. So that's why they took this roundabout way to increase the standard deduction, because they knew they couldn't get 60 votes to get an actual change with anything that dealt with Social Security directly.
Well, however they got there, I'm sure those who will benefit from it will be happy about that.
Exactly.
Regardless of how you feel about the rest of the bill, at least in a vacuum, this little piece of it is, I think, going to help a good amount of people, it sounds like.
Yeah, I totally agree. And that might have been a needless wade through the weeds, but we have a lot of inquiring minds that listen to this podcast.
Yeah,
so.
Well, I like to understand the why behind things, and I hope a lot of other people do too.
Yeah.
We need more of that, so that's a good thing. Don't shy away from that, please, David.
So that's all I really had to say on the no tax on Social Security. It's really an increase to the standard deduction. It's a really good thing for middle-income Americans, but it expires in 2028.
Okay, sounds good. What else is there on the big 800-plus page bill that caught your eye that would apply to a lot of our folks?
Yeah, so number 2 was the increase to the SALT deduction. And that's just, SALT is an acronym for state and local taxes. And pre-2017, you used to be able to add up all of your state and local taxes. Think of this as property taxes, income taxes that you might pay to your state or your city, sales tax on a car or a boat. You add all those things up and just take them off of your income as you're calculating your federal tax liability. But in 2017, there was a limit placed on that of $10,000. Well, you might look at your own property tax bill and go, well, my property tax bill is bigger than $10,000. If you itemize, so if you don't use the standard deduction we just spent a little bit of time talking about, if you itemize, you were limited to only $10,000 of property tax, income tax, and sales tax on the state level. What they did for this tax bill is they increased that to 40,000. They didn't uncap it, and there was a lot of discussion as to whether to leave it at 10,000, move it to 20 or 30,000, but they settled on 40,000 after negotiating with a lot of congresspersons from New York, New Jersey, California, where state taxes are pretty big. So from now until 2029, when this has to be fought over again, you get to take off, if you itemize, 40,000 property tax, income tax you pay to your state or city, and sales tax you might pay on a big purchase. So that's a really big change if you happen to be in the situation where you do itemize. So probably more of our working listeners who own homes is my guess as to who that's really going to impact. But that's a really nice big jump in that deduction if you itemize your deductions.
Yeah, makes a lot of sense. Be interesting to see the impact, and I'm sure various states, as you mentioned, you might be in kind of a middle tax state where you don't see a whole lot of improvement there, but some of the larger tax states, could be a huge benefit for somebody.
Yep, for sure.
Big savings, potentially. All right, what about the third and final thing that jumps out to you from the big, beautiful bill?
Well, the third is kind of minor, but it used to exist, I think for like 2 years during COVID, and they just brought it back. So most of our listeners would know, if you're doing the standard deduction and you give money to your church or your university or some other 501c3 or tax-free organization, you know that you used to be able to claim those charitable contributions on your tax return. But if you don't itemize, you don't get to. And that's where the whole qualified charitable distribution came from your IRAs, a way to get around not being able to claim those charitable contributions. What this change did is say, you know what, even if you take this nice, juicy, new increased standard deduction, we're still going to give you a charitable contribution deduction off of your taxable income, up to $1,000 for an individual, $2,000 for married filing joint. I'm not aware that this ever expires, so I believe this is a permanent until a future Congress changes it. But I believe this is a permanent change to tax law, that regardless of whether you do the standard deduction, if you itemize, you're already getting to put charitable contributions as a deduction. So standard deduction now, instead of not being able to deduct a charitable contribution, you can. So nice little addition around the edge for people who are already doing the standard deduction, but are still making contributions to their church or their university.
Yeah, it's nice that they brought that back, I think, even though you don't give, like, it's not usually the spirit of the giving is to get the deductions, but and I don't know, it kind of took away some of the excitement, I guess, if I can say it that way, David, when they got rid of that. And if you were still doing the standard deduction, it just, I don't know, it kind of felt nice to get credit for it or have it tracked in a way. There was something psychological, I think, going on there.
Yeah, agreed. And when that went away, people would still bring in their receipts and go, well, what about these? And we're like, sorry, that doesn't work anymore.
Right.
But now it does.
Yeah. Count it anyway, please.
Yeah. No. IRS checks that stuff pretty closely.
Yeah, exactly. Well, great breakdown of these changes, David. And I know we'll dive a little deeper maybe on some additional items coming up on our next episode, but to keep it easily digestible today,
I'm already getting hit with some questions. In fact, as we were chatting before we started, you mentioned that you'd heard some questions from family members. So I think what we'll do next time is put together a little montage of questions that we've either heard from listeners or that I've heard in my office, things that you've heard, but maybe 5 or 6 different things that we want to go a little bit deeper in on the next episode.
Love it. We'll hit it from some more angles. Certainly, this is dominating the news right now, but we've got some time to digest this, folks, and see what comes out of it. Talk a little bit about the planning, opportunities that might exist in 2025, 2026, and beyond as well. So we'll break that down some more on those in the next episode with some of those additional questions. In the meantime, if you've got specific questions for David about how the bill or anything else going on in your financial life is going to impact your financial future, don't hesitate to reach out. In fact, you can schedule a CPR review of your plan. That's the CPR process, the complete planning review that David takes people through. You can get in touch and set that up by calling 913-317-4673. 1414, or check out the website creativeoneadvisorsgroup.com. More resources and ways to get in touch there as well. We've got contact information listed in the description of today's show so you can find it easily as always. And David, thanks for the great breakdown. Have a good rest of your week, and we'll talk soon.
Yeah, I will look forward to that, Walter. Thanks.
Yep, we'll see everybody next time right back here on Cover Your Assets, KC.
Creative One Advisors Group has been proudly serving families in the Kansas City metropolitan area since 2003. Over the years, we've evolved to help meet the needs of our clients, becoming KC Financial Advisors in 2010. In November 2021, our advisory business was acquired by Creative One Wealth, LLC, C1W, and in January 2025, we officially adopted the name Creative One Advisors Group. Previous episodes were recorded under the branding of KC Financial Advisors, which has since been rebranded as Creative One Advisors Group. Any references to KC Financial Advisors should now be understood as referring to Creative One Advisors Group. Investment advisory services are offered through Creative One Wealth, LLC, a registered investment advisor. Creative One Advisors Group is a DBA of Creative One Wealth. Insurance services are offered through licensed insurance professionals. Investment advisory services are provided in accordance with the fiduciary duty of care and loyalty that includes putting your interest first and disclosing conflicts. Insurance services have a best interest standard, which requires recommendations to be in your best interest. Creative One Wealth is not affiliated with or endorsed by any government agency and does not provide tax, legal, or estate planning advice or services. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss. Neither asset allocation nor diversification can ensure a profit or guarantee against losses. None of the information contained herein shall constitute an offer to sell or solicit any offer to buy a security or any insurance product. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. The Creative One family of companies includes Creative One Wealth, LLC, a registered investment advisor, Creative One Securities, LLC, member FINRA SIPC, and a registered investment advisor, and Creative One Marketing, LLC. These companies share common ownership. Additional details regarding advisory services are available in our firm's ADV Part 2A and Form CRS.